Welcome, everyone. I'm Brett Theodos at the Urban Institute. Thanks so much for joining today. We're excited to have you for what I think will be a really engaging discussion. Wanted to give a special thanks to our funder for this work, the MacArthur Foundation, and John Balbeck in particular for supporting the work. A few housekeeping things before we get started. The webinar is being recorded, and we will send out the slides, so you will have that available to you. You'll be on mute for the discussion, but please type any questions or comments in the boxes as we go along. So with that, I want to hand it off to Melanie Audet to frame the discussion and introduce the speakers. Melanie is a senior VP at Mission Investors Exchange, which is leading impact investing network for foundations. Started in 2005, MIE's membership includes 250 organizations dedicated to deploying capital for social and environmental change. Thanks, Melanie.
Thank you, Brett, and welcome to almost 300 registrants today to the webinar Tracking Capital Flows and Gaps in Community. For any type of investor in communities, understanding how the dollars are flowing or not, and where there are real gaps to be filled is essential to your success and the success of your community. Applying some of the methods you'll hear about today may help you to increase capacity to attract community investment. It may help community developers to identify projects in need of financing, help you to raise or deploy capital more effectively, or even aid in the design of marketing designing and marketing new financial products and services. Many of those in the Mission Investors Exchange network are place-based foundations like community foundations and private foundations working with and in local communities to tackle local problems like affordable housing and creating quality jobs. They often learn about need through conversations with peers and with grantees. And more often recently, they're learning directly from community leaders and end users of the products and services their grantees provide. But they need more than good conversations and anecdotal information, and that's where this report comes in that we'll be talking about today. We've been pleased and honored to be working over the past year with the Urban Institute team, Erica Pothig, Sheena Ashley, Matt Eldridge, and others, including you, Brett, to create a knowledge platform for practitioners in place-based impact investing. Together, we wanted to establish clarity on what's meant by the term and just how place-based impact investing is being advanced through the blossoming collaborative efforts around the country. The tools we're developing are meant to lower barriers of entry for new actors and facilitate knowledge exchange not only in the foundation community, but across sectors. With corporations and anchor institutions like universities and hospitals increasingly coming out as impact investors in place, along with state and local governments and developers, we're seeing more often communication, if not coordination, among new and different actors concerned with impact and equitable communities. Please advance the slide, Haley. Urban has been leading the research and analysis, and if you see this report, Investing Together, about those emerging approaches on the Urban Institute website, we're carrying out convenings with leaders to share knowledge and have them inform the reports, and we're disseminating the findings in a variety of ways, like webinars. The project wouldn't have been possible without the generous support of John D. and Catherine T. MacArthur Foundation. Again, thanks to Deborah Schwartz and John Balbeck. Slide, Haley, please. The webinar today is based on this report, Measuring Community Needs, Capital Flows, and Capital Gaps, which is complementary to the place-based knowledge platform, but leading in its own right. You'll find that the report is practical, providing a how-to guide, 5 approaches to assessing community need, a 4-step process to study capital flows, and 11 approaches to determining capital gaps. We'll ground this today in an example from the Twin Cities of Minneapolis and St. Paul, Minnesota. Let's introduce our speakers. Haley, let's move the slide, please. We have with us today Tawana Black, who is the founder and CEO of the Center for Economic Inclusion, the nation's first cross-sector organization dedicated exclusively to advancing an inclusive regional economy. She's also the executive director of Northside Funders Group, a place-based collective impact organization of 20 corporate, community, and private foundations and public sector investors committed to aligning investments and strategies to catalyze racial and economic equity in North Minneapolis. Next, we'll have Robin Hackey, who's the co-founder and executive director of the Center for Community Investment at the Lincoln Institute of Land Policy. The center helps leaders assess and strengthen the capacity of their local community investment system to attract and deploy capital so that everyone has a fair chance to lead a healthy and productive life. A former venture capitalist and investment banker, Robin holds an MBA from Harvard Business School. And finally, we have Brett Theodos, who is the lead author on the Needs, Gaps, and Flows study that we'll be discussing today. He directs the Community Economic Development Hub at the Urban Institute, where he's a principal research associate in the Metro Housing and Communities Policy Center. Brett, let's start again with you.
Thanks so much, Melanie, and excited to jump into some of this content. As mentioned at the top, we'll be taking questions and comments, so please go ahead and use your question and comment box along the way. So this work started with a couple different motivations in mind, but one of them was that we have been increasingly doing work tracking capital flows into local markets to understand how they're getting investment and how they're not getting the investment that they need. So we've got reports up now on capital flows into Detroit on our website, and we'll shortly be coming out with a couple of products looking at Baltimore. We're also doing work looking at Chicago and at Memphis. Different projects, different funders, but all creating a body of work that helps us to understand capital and its deployment. But we wanted to step back, especially with partnering with MIE and with support for the MacArthur Foundation, to think through how we could take and generalize this learning to be more helpful to the broader set of impact investors, philanthropies, local governments, and other partners that were interested in how much capital was getting where. And so we set about doing that. We scanned a bunch of research studies, which are actually the inventory of those is actually included as an appendix to the report. So hopefully you can see that too. One reviewer actually thought that was the most helpful part of the report. So I'll commend that section to you, where we scanned a bunch of the literature available on how other people were tracking capital deployment and capital gaps. And in setting about doing that, we realized there was a third leg to the stool that we needed to articulate well as well, which was community needs. So I'm going to organize the talk around these three approaches, three questions, three lines of inquiry. First is how we measure and understand community needs. And the next is how we understand capital flows. And the last is how we understand capital gaps. All right, so let's start with community needs. What are community needs as we're articulating them? We're defining community needs as assessments of community need that is determining an unmet demand for a particular good or service. So this is not, as we're articulating it, about the capital per se, but about what the capital creates. So this is about grocery stores. This is about affordable housing. This is about all the sorts of things that make communities thrive. And so how do people begin when they're thinking through an impact investing strategy, a place-based one, or just thinking about community development more broadly? How do they begin to do needs assessment? So there's a lot of literature that looks at needs assessment. Really, this is quite built out in terms of what we know, though more in some asset classes and ways than in others. But what we wanted to identify at a higher level were 5 ways to get at needs. And there really are a number of strategies that can help to understand that. And so you need to potentially look at the local environment. You need to subtract maybe supply from demand. You could survey or interview. You could examine the use of a suboptimal alternative. We can talk a little bit later about what that might be, but some studies, for example, have looked at the use of alternative financial services as a means to understand a community need of banking, but there's other approaches there as well. You could compare average levels of service across geographies that look comparable, or that look comparable in terms of attributes, but don't look comparable in terms of the distribution of medical services or grocery stores or the like. And then lastly, you can analyze services spatially. So let me help by putting some example to this and show you what we did for the Twin Cities of Minneapolis and St. Paul. Taking data from the USDA and also from the American Community Survey, here we have mapped out the share of a population that has no vehicle and has low access to grocery stores within a half mile. And so what you can see with this kind of spatial mapping exercise is an illustration of where there might be community needs for greater fresh foods. So this is just one example of an approach. I wanted to show you a second example as well in a different space. This looks at affordable housing. This isn't a spatial analysis in the same way as the previous one, but can help explain how individuals are able to access affordable housing. So what we have here, the blue bars, light and dark, are Minneapolis, and the yellow bars, light and dark, are St. Paul. And so what you can see in the darker shades is the share of households that fit within a given income band, and then the share of units available and affordable to at that income band. And so you can see a very clear mismatch between households and housing units at the lower income levels in particular, a real undersupply. So these are just two examples of ways that communities can understand local community needs. Again, subtracting supply for demand, surveying or interviewing community members to understand their perceptions, examining suboptimal services, comparing average levels of service, or analyze spatially the needs. So once we have an understanding of what a community needs in its locality, we then need to begin to understand what capital is actually already getting there. And there's, again, a number of different ways that this can be gotten at, and it will depend absolutely on the geography of interest and the asset class of interest and the potential funder and funding vehicle of interest. But we did identify some commonalities in approaches that we think would be helpful. So we have 4 steps that we want to walk people through in measuring capital flows. And before we get in, I want to define a capital flow, but even before that, I wanted to ground this in one very real and contemporaneous example that we're spending a lot of time thinking about, which is opportunity zones. I'm sure this is coming up for a lot of you as well, but what we're seeing is a lot of interest in understanding zones and how capital is flowing to them. So I don't have slides on this because we wanted to keep the example local in Minneapolis and St. Paul, but what we have done separately is provide capital flow information for all of the designated zones in the country, where you can go and look up how much capital is flowing to the zone and begin to understand what that nature of capital is, and are there places that are getting a lot of capital or places that are getting relatively little. So whether you're motivated by understanding opportunity zones in terms of capital flows, or a separate place-based impact investing strategy, or just community development more broadly, this is the type of approach and platform line of inquiry that can be helpful in understanding how investment is happening. So what is a capital flow? What do we mean by capital flows? Well, what we're defining it as is the flow of the provision of financing to a household, a business, or a community. And as you can see in that definition, there's some pretty different sets of actors that are involved, whether we're talking about households or businesses or communities. But there are some commonalities involved for all of these that we want to be able to walk people through. So what are the steps to measuring a capital flow? So first, we got to get data. We got to get data from any number of different sources. It could be from government agency reports or a trade association, such as mortgage deed data, realtor home sales data. There's also a number of private data vendors that will be willing to sell data to you. Of course, philanthropies and impact investors themselves are making investments into communities, CDFIs, CDCs. They have data about what investments they're making, local governments, and then original data collection as well. So there's a range of different actors that have data that can be helpful to articulate for the in order to track a capital flow. And part of the first step is just investigating who are the people that have the data that is principally of interest. Step two, once you've identified the data, and it looks so easy when I write it out on the slide, but really the hard work is getting the data use agreements in place if need be, tracking down the metrics, trying to make sure you're really defining things in the way that want to be that need to be defined. So we don't underestimate how hard it is to access the data, but we do have some resources available as you're beginning this line of inquiry. So your second step after you've done that is to aggregate data to the study geography. Are you interested in the city overall? Are you interested in just a certain neighborhood in the city? Are you interested in comparing different cities or different counties? Are you interested in comparing different neighborhoods or all neighborhoods? So that's the second step. The third step is to consider presenting the data in an easily interpretable scale. So we think this is important and shouldn't be overlooked. So not all neighborhoods are the same. So if we compare how much multifamily investment is going into a neighborhood in terms of a capital flow, that'll look pretty different for a neighborhood that's all multifamily stock versus a neighborhood that's all single family stock. And maybe you want to know that, but maybe if what you really want to understand is capital flow, not just because you want to understand how the land is composed, but actually what the flow is relative to what it reasonably could be, then we're going to need to think about some sort of scalar. So that could be something as simple as the number of people. It could be the number of owner occupants. If you want to study mortgage financing, you might scale it by the number of owner occupants. Could be the amount of multifamily scaled by the number of multifamily units or the number of rental units overall. Could be small business financing scaled by the number of what we have done, number of employees in small businesses, or you could use establishments. So there's a range of different scalars that might be appropriate given the line of inquiry, but we would encourage you to think through that as you're constructing the indicators. And then the fourth step is analyzing data for easier consumption and greater insight. So for example, you could do things like study the change in capital flows over time, or you could study different types of capital flows and compare them, or you could study spatial concentrations of capital flows. So oftentimes we found at least that the analytic work is not altogether too hard to describe in simple descriptive terms the capital flows, but it is a decent amount of work to get the data and then get it managed in a form or process that is easily digestible and absorbable to your users who might themselves not be very familiar with the data or the questions at hand. So I'm not going to try to make you absorb all of the rows of this chart or of the next one, but just to say that we have done something of a data inventory for you for data sources that are available, and we have included that also in an appendix in the table. There are, to wrap up on flows, some cross-cutting strategies for data that you could consider in presenting your results. And some of these will be more applicable to some lines of questioning than others, but they may be something that you want to consider. So first, as we mentioned, you may want to consider some sort of spatial analysis. It may be helpful to look not just at capital flows, but actual deal sizes, and with more specificity. It may be helpful to look at source of the lending. You may want to know just how much lending is coming into a geography, but actually for what source. So we did this for Detroit by way of example, where we have a publication describing that among all multifamily and commercial, industrial, and institutional investments into Detroit for the years 2013 to 15, that 42% of all investment either came from a mission lender, from from a mainstream lender, but that leveraged the mission lending, or was government public sector subsidy. So looking at source of lending can also help to clarify and understand who is involved in understanding capital flows. And then the last one that's absolutely important is trends over time. We definitely see cyclical effects with national and regional economies, and those absolutely filter into neighborhoods as well. So strategies over time, trends over time. All right, let's make this practical with a couple of local examples. So our first example is, again, looking at Minneapolis and St. Paul. Here are some tract level investments into commercial real estate. So you can see, unsurprisingly, perhaps a lot of the investment in commercial real estate is coming downtown, but there are pockets in other communities that are also attracting a lot of commercial investment as well. And our next example looks at, this was harder to construct, but we looked at CDFI lending into Minneapolis and St. Paul, and then also the leveraged lending that happens from mainstream lenders that's to the same address in the same time period as CDFI lending. And so we've called those leveraged and combined them together. So this is actually mapping out where CDFI lending happens within the cities of Minneapolis and St. Paul, which may prove useful in understanding a place-based investing, impact investing strategy. Okay, last leg of the pillar is capital gaps. And this is what motivates a lot of people to investigate capital flows. Capital flows are certainly of interest on their own right, but a lot of times we want to understand capital flows because we're actually worried that there exists a capital gap of a certain product, of a certain level of finance, or in a certain geography. So, however, capital flows are not the only way to understand capital gaps. There are different ways. So let's start again with a definition and framing. What do we mean by a capital gap? We have defined a capital gap as occurring when investors fail to make financing available for investable projects. And again, this can happen in small business or real estate, a number of different asset classes. And what we identified in our work is 11 different methods to capture or measure a capital gap. And these are not necessarily mutually exclusive, and they will produce somewhat different answers and will be more or less helpful for different lines of inquiry. So what we wanted to do, though, and we found helpful for our own thinking at least, was to try to step back from all of the individual studies that we scanned to be able to say, what are the ways that we can begin to understand a capital gap? So we're not going to go through each of these in depth because we don't have the time on this webinar, but we have a pretty thorough discussion and replete with examples of each of the 11 ways. But let me tick them off just briefly on the webinar. So first, and just to add as well, in the paper we have strengths and limitations of each of these approaches as well, because they all have strengths and limitations. So a first way to understand a capital gap is to ask borrowers. You could go to small businesses, could go to developers and say, do you need capital? How much capital do you need? What type of capital do you need that you're not getting? Oh, we're not getting working capital for this, or oh, we're not getting mezzanine finance for that. Next, you could ask capital providers. So not borrowers, but capital providers. You can go to lenders or investors and say, what do you perceive the capital gap to be? You're able to provide this type of financing in this amount. When people are walking in your door, what do you see that? And that could be in general terms of this type of loan product, this type of investment, or it could actually be attempted to be quantified. Some studies have done this. Actually, how much, if you had additional capital, how much could be deployed? A third approach to measuring capital gaps is to ask both borrowers and providers, where you can begin to try to triangulate because they may not agree with each other. A different approach from the others that some studies have done is actually to quantitatively estimate demand and supply and calculate the difference. And there's some interesting examples of where that's been done. A fifth approach is to calculate lending denial and frustration rates as a proxy for the amount of demand that's there that is not being met, that is a gap. The next approach is to compare a moment in time to another. So if we're looking at the depths of the foreclosure crisis to a more normal period, we can actually describe how much of a capital gap there is because of retrenchment of lenders willing to take on risk. Then we can also compare one place to another. Again, probably important to use scaling variables, but that might describe there's no reason to think why this neighborhood and that neighborhood would need less housing finance. They have the same number of homeowners or single-family homes or condos, but in fact, we see very different numbers in terms of the amount of capital being provided. So all of this can be useful in helping to ask the why question and also in helping to establish the solution set available. Another way to look at capital gaps is to compare a place to another, is to analyze differences in capital use between groups. Again, we can look at the use of less desirable financial services as actually means to establish a gap. We can actually go ahead and reconstruct an underwriting box and therefore work out what a capital gap might be. And then last, very hands-on, could actually implement a product, offer a type of financing and see what the take-up is as a means to understanding whether there was a gap and how big it is. So let me help illustrate a couple of these methods, and we've got more illustrations in the paper, but just a couple of them with, again, another local example. So this is a potentially exploration of capital gaps in small business finance. So this is looking at high, moderate, and low poverty neighborhoods in Minneapolis and St. Paul. And it's looking at the amount of financing that's available per employee in those settings. And so you can see the distribution of financing available and a lot more of the loans that are going to the high poverty neighborhoods are lower in size than is the case, for example, in the low poverty neighborhoods. We can take an analogous look at the small business finance in Minneapolis and St. Paul for neighborhoods that have majority residents of color and neighborhoods that have majority white composition. And again, we can see when we look at the data for Minneapolis and St. Paul that a much higher share of the loans going to neighborhoods that are majority residents of color are small in nature compared with the majority white neighborhoods. So these are just a couple illustrations to help us understand how it is that capital gaps can be measured, and then hopefully how it is that they can be used to motivate action. So with that, I want to turn it over to our next speaker, and Raman will help us understand the work that she's been doing around capital absorption and how an understanding of capital flows, gaps, and community needs can be useful in that context.
Great, thank you so much. So I've been following Brett's important work for several years, and I am a Brett Theodos fangirl. This paper is a real contribution, we think, to the field. As people who spend our days working with communities on community investment issues, this really is kind of critical back office support that can make the work a lot more powerful. I'll tell you a little bit about what we're doing, and you'll see why Brett's work is really going to help us advance the efforts that are underway in a variety of communities. So community investment, as it's defined by us and in Brett's paper, delivers capital to places that it wouldn't otherwise go. And so if you think about it, in a capitalist system, money goes downhill to the easiest and most profitable deals. The work that we're doing on community investment is work that blends money from a whole bunch of different kinds of investors to go uphill. And as you might imagine, making money go uphill would be a complicated endeavor. And some places are better at it than other places. We call their ability to make money go uphill their capital absorption capacity. And part of what we do in our work, which is very much assisted by this paper, is to think about, well, what would it take to measure the current performance of our ecosystem relative to others and relative to its potential? And then what would it take to build that capacity so that it more accurately and completely reflects the desires of the people who live there? So when you see real deals like this one, and this, the names have been stripped to protect the innocent, but this is what community investment deals really look like. This is what it takes to make money flow uphill. And you can understand when you look at something this complex, why practitioners sometimes get stuck focusing on individual transactions. But we know that if we're going to achieve the objectives that we've set for ourselves around affordable housing, around economic and small business development, or climate resilience, we really can't operate at the scale of one deal at a time. And so the work of the Center for Community Investment is to help communities and institutions think at the systems level. And if you go to the next slide, please. We've developed a framework that helps communities and leaders in those communities think about how to increase their capital absorption capacity, or in Brett's terms, how to think about what the community needs through the needs assessment and how the capital flows can be increased to help to meet those needs. And essentially what we say is that a robust community investment system, one that delivers capital to the things the community is trying to achieve, is going to function well along three dimensions that we work on with these communities. The first is they have to be able to create a shared vision of what they're trying to achieve that's specific enough to shape the decisions. And as you might imagine, having the different methodologies to do the needs assessments can be really helpful there. I'll talk more about that in a second. The second function is there has to be the ability to generate a pipeline of deals and projects that add up to the realization of what the community has asked for. And that's where being able to assess the capital flows can really make a difference. So we'll talk about that in a minute as well. And then finally, the enabling environment is all the policies and practices, relationships and networks, ways of doing business and platforms for collaboration that either make it easier or harder for the community to achieve its objectives. So next slide, please. When we start working with leaders in a place, the first thing that we do is convene the stakeholders across a number of different sectors to get them thinking above the level of the transaction, those complicated deals that I showed you a minute ago, and create space to make the system visible. This is where Brett's work is really helpful on the needs assessment side. What we found is that as the leaders are defining their priorities, both choosing the problem that they need to tackle next and thinking about what it would take to tackle that problem, it's really important to have the data that can galvanize action. And I'll tell you a story about what happened when we tried to do this. We were working with a very powerful, very capable team in the Bay Area. And they were focused on how do you increase transit-oriented development. They did something that we call the denominator exercise, but it's basically a variation of taking the capital flows as measured in Brett's paper and putting it over the denominator, which is the unmet community need. And so if you think about affordable housing in the Bay Area context, we were asking them to figure out how much affordable housing are they creating, are they financing every year, and then try to compare that to what actually was the need for affordable housing in the region. And what we found when they did this denominator exercise is that they ended up quite depressed because here they were, one of the most capable community investment systems in the country with capital absorption capacity and capital flows actually far beyond what many other places could wish for. And yet the scale of what they were doing compared to the unmet need was really not very big and going in the wrong direction. When you get that kind of data, even if it's not perfect, even if it's just rough orders of magnitude, that really can galvanize people to behave differently, to approach their work differently, and to think beyond the level of individual transactions to really get at a more systems-oriented approach to changing what's done. And so we find that this ability to use data to think about what could we be doing, what should we be doing, as opposed to just what's happening now, is a really useful approach. And I think one of the values in Brett's paper is that this is not the kind of methodology that has to be handed over to a consultant, where you pay a lot of money and wait 6 months for a report. These are the kinds of methodologies that people in the community, leaders themselves, can use to get enough of an approximation of what's going on to be able to start thinking very strategically about how to take steps to make things better. And so if you think about the pipeline, for example, by using the information around flows and gaps, we can find ways to address batches of projects that are very realistically targeted to what we can do in our community, rather than spending lots and lots of time, as many communities do, on structuring funds that they think will meet a need, but in the end, there aren't the opportunities to deploy that capital. So I will skip to the next slide in the interest of time. There are a couple of points that I would raise from lessons learned as we've used data in our work. The first is that a very important function of getting some of this data in front of people is, as I mentioned, the galvanizing effect. So it's less important for the data to be precise to the fourth decimal point than it is for people who can make decisions based on the data to have rough approximations of what's going on. What we find is that in this, as in many things, the perfect is the enemy of the good enough. And if you can get data started, begin to get some initial findings, and then begin to move based on the data that you see in front of you, that's actually a lot more useful to the community than trying to refine things, trying to outsource them. And I think the other value that we're seeing in this paper is that there are any number of ways that government at the federal, state, and local level can act to make the data that's so important to doing this work more readily accessible. And I'm hoping that the companion piece that Brett will put out next is some recommendations on exactly how to do that. Happy to take your questions. This is obviously just a quick summary, but we very much appreciate the work that went into this paper, and we look forward to using it in the communities that were active.
Great.
Okay.
Thanks, Robin.
Back to you.
Yeah, that's great. Thank you so much. Let's go to Tawana.
Good morning, or afternoon it may be for some of you. First, a big thank you to the Urban Institute for hosting this, and as well to my prior colleagues for speaking at this for this webinar. I applaud the research that's been put forth by the Urban Institute, and I particularly appreciate it being able to highlight the Minneapolis-St. Paul region, and certainly echo all of the comments that have been offered so far and the instruction that's been given. I want to give a little bit of context to our organization at the Center for Economic Inclusion and the framework and lens that we use and apply to our work, as it'll guide the reflections that I have about the research and the ways that communities can use this research, but as well the assets and intel from their own communities to begin to accelerate the way that capital flows and is deployed within their communities to address racial and economic gaps. The Center is an organization that is, as said, a newer organization that is cross-sector and is designed to get to an economy that works for everyone. And we take that work on through a lens of race, place, and income, working at the intersection of human capital, economic development, transit, and access. And as we think about this research and the way that capital either flows or is stunted from flowing in neighborhoods that we see as neighborhoods of opportunity in our community that are often viewed as neighborhoods that are challenged, we think it's important to both assess those community needs, but also critically important to think about those needs and to assess the opportunities that can come by addressing those needs through the investment of capital in communities that have historically experienced disinvestment, and how investing that capital by accelerating the way that capital flows, by creating more pathways for capital to flow, and by highlighting and kind of elevating the platform for capital success in neighborhoods, we can also increase and advance regional economic growth. For instance, with the data that was shared for grocery and for the food deserts that occur across much of our country in low-income neighborhoods that have experienced significant gaps in grocery and other retail services and amenities, we know that we have data that'll help us assess not only the gaps in food or amenities or retail, but we also have data to help us assess the secondary implications of those gaps. And it's been important in our experience to be able to highlight for investors not only that a neighborhood doesn't have the same level of food access as the next neighborhood close to it. So in our case, if we were thinking about North Minneapolis, to say how far do North Minneapolis residents have to travel in order to access healthy food and grocery, and how does that rate compare to downtown residents or residents in the next suburb or next city, but also what will it do, and what are the implications that we experience today, and what are the economic costs and burdens of us not having equitable capital flowing so that grocery is occurring in neighborhoods like those that were highlighted in the slides and presentations earlier. And then thinking about the reverse, if we were to invest in capital flowing, if we were to accelerate the flow of capital in those neighborhoods, what's the opportunity? What's the economic opportunity, not only for people in that neighborhood, but for the entire city or entire region? And that's been helpful for us to ensure that as capital is deployed, we're thinking about not only to who, but for what purpose, and how do we evaluate that, as I think was highlighted just a bit ago. We believe that it's important for these conversations and the data to be framed in an economic opportunity framework in order to both attract but also sustain the level of economic investment that's required to not only increase commercial development or business development for one development or developer or one neighborhood, but to truly turn the tide and begin to have economic equity in all neighborhoods. We also find that it's important that we understand the experiences that developers and business owners of color, those who are from communities who understand them best, are experiencing, and know what the differences are from one developer to the next, from one business owner to the next, in attracting capital, sustaining capital, and being able to use that capital to turn the tide in a neighborhood that has experienced disinvestment and challenge. We know from data that business owners of color are more likely to hire low-income people of color, particularly those who have been most locked out of our economy, thereby increasing and accelerating economic inclusion and opportunity. So when we understand the barriers those business owners have faced, the opportunities that they need, and it's specifically barriers to capital deployment, but barriers to opening. We're able to take that on really directly and couple the data points together. Our organization has worked in spaces of coordinating investments, helping both developers and business owners piece together the resources of capital, where in one case you might have capital that's flowing from a nonprofit CDFI or from a bank, but still have a gap to close. You may have funds that are flowing from the public sector, from government resources, but need a CDFI to be able to step in and see a project that may be non-traditional in more traditional ways that can begin to solve for some of these capital flow gaps. We provide support to individuals, to lenders, to businesses to develop new models for deploying capital, and or more recently, stepping into the space to help us think about in our region the deployment of angel capital, of venture capital, and other gap closing tools that have historically not been considered in neighborhoods that have been disinvested, such as mezzanine gap funding models in our neighborhoods. I want to echo the model that Robin lifted up and the importance of having shared visioning, a solid pipeline of demand that aligns with that vision and the enabling environment, and talk a little bit about the ways that we experience that and lead through those three lenses here in our communities. For shared vision, we believe it requires people being in communities and community being central, the strategies being people-driven, people-informed, community-central, market-driven, and data-informed. And I think one of the challenges that we've experienced across the country historically is that we have strategies for increasing capital deployment that are one or the other, that may be very highly data-informed, but may miss the mark on being people and community-informed and centric. May start off having community at the table, but 8 or 10 years into a project that is deploying capital may lose that focus on the community and people and have a much higher focus on the capital deployment by the data. And what you tend to see in those cases is we have buildings that are up, but we don't have businesses that are inside them, or we have businesses that are inside that have come from outside the community, but we're not plugged in enough to the community to be able to stay. So we see buildings that have gone up, but again, maybe empty 8 or 10 years later. So that capital deployment needs to be grounded in community. The opposite can be true if we have it be very highly focused on people in community and the vision and the hope, but don't have the data to know how to piece together various capital streams, or are not market informed. So we don't know and cannot predict the way that the market is going to turn, may not be able to predict what types of businesses to put in close proximity, or what types of businesses can hire the workforce that is most readily available. So having all three ingredients as we look to create that shared vision really create the opportunity and the platform for both investors and a community to be successful. Having the solid pipeline we find is really not very hard often. There often is a solid pipeline of businesses who are interested in being more closely related and tied to the communities that have the workforce that they need to grow and sustain their business. You often also find developers who are interested in building, whether it's because there are tax credit programs that allow them to benefit from developing in a particular community, or familiar with that neighborhood and want to develop. That said, it is important to have communities who have leaders with both the intel and intelligence to attract those businesses and developers and to create the right model to sustain growth without gentrification as we deploy that capital. And then that leads to that third element of an enabling environment. We realize that often we consider one lane or another when creating that enabling environment, making development in disinvested neighborhoods move faster. We might rely on new market tax credits or opportunity zones, but in our reality, we've learned that it's important to understand the entire environment of what is maybe serving as a barrier or multiple barriers for accelerated development and growth and addressing those capital flows. Understanding that it is often, yes, capital, but also the barriers that start before a developer or business owner is ready to access capital, I should say. being able to understand, in our case, we've developed a strategy in North Minneapolis in partnership with our public and private sectors called Making Development Easier, where we assessed and learned that it wasn't only about access to traditional or non-traditional capital, but also the barriers to zoning changes, the barriers to, and the speed to which we're able to approve projects, the ability to be able to engage community and walk alongside community when a project is coming online, but also make sure we're walking alongside community the entire process and having organizations and leaders who could support that in a way that, again, is people and community centric. I wanted to be able to elevate a couple of examples of this just in closing that really relate to the examples that were offered before. One relates to the grocery example. We have a grantee, the North Market, led by Pillsbury United Communities, who was able to assess the gaps in food access in North Minneapolis and determine the need for that store. And ultimately, in partnership with our county opening a new library, be able to build a new grocery store. And seeing the investments of both grant funding from our philanthropic community, foundations and corporations, local donors, and public investment from the state of Minnesota and many other streams, see that grocery store open. But the project enables really, and it's a good example of what I've raised before about the need to also be invested in understanding community and walking alongside community, and having those investors understand what it takes to not only deploy capital for the physical infrastructure or for the business development to go into a new building, but to also deploy capital to ensure that we're turning the tide on the economics of a neighborhood. Filling a need isn't just filling the need the day that the store opens, but turning the tide such that we change buying patterns, that we change habits of customers and consumers in a neighborhood, that we improve incomes in the entire neighborhood at the same time that we're adding amenities such that the store can survive and thrive, is important and requires a different type of capital deployment, often grant funding or forgivable loans, alongside the type of capital that's required to build the infrastructure. A second example for us that's much more recent is the Regional Acceleration Center, home of Thor Companies, META, Build Wealth Minnesota, a Target Conference Center, Sammy's Eatery, Hennepin County, and more. This project was led by and owned by the Thor Companies, one of the largest African-American owned companies in the country, and required securing master leases and tenancy with Hennepin County and Target, selling parking spaces to Hennepin County, at the same time getting our private sector leaders and bankers to lean in on what may have seemed like non-traditional lending and capital support to make a significant project happen in the heart of a community that had not experienced such investment in many, many decades, but required everyone at the table to think differently and creatively, and yet not so differently or creatively than we might think in any other part of our region or city. So as I think about communities who are listening in on the webinar, I think it's important for us to not only assess the needs of a community, but again, to assess the economic opportunity that can come from really investing deeply. But that requires putting communities themselves right in the forefront of the seat and making their data, their intellectual data, their experiential data be just as equal as the data that we have about why it is or isn't a wise investment to spend dollars in a community. I'll stop there so we can move to Q&A.
Thank you so much, Tawana. That was a terrific local example and especially grounded in all the good work that you're doing there. And Robin, your work as well, I think really helped illustrate exactly how this kind of approach can be helpful in actually changing things on the ground, which is definitely the hope and the goal. So we got a number of good questions, more than we have time allowed for in the webinar, so apologies in advance for that. Let me take off the easy ones and then we'll get to some of the bigger ones. First, yes, there was a question about how we can get and access the recording. We will send it out to the same email that we had when you registered, and we'll also post it to urban.org. And somebody asked if they could get access to the database that we have that tracks capital flows into opportunity zones. We will include that as a link in the send as well. Okay, so a couple of other questions that came up. A few people asked, how are we defining what an investable project is? Who does that defining? And to that, I would, I guess, point to the studies that we've included in our appendix. Each one has taken somewhat different approaches. And so I think there's not necessarily going to be just one easy answer, but we're not totally adrift here either. There are a number of studies and approaches where people have tried to specify what they quantify as investable versus not, and draw a line somewhere. Obviously, that line is going to be debatable and may have some squishiness attached to it, but there is something of a track record of doing that. So depending on what kind of capital we're talking about, I would point you to our paper and the structure of the other papers and how they're looking at. Then there were a couple of questions or comments that were along the lines of, is investment always good? Is more capital always better? And do we need to know, in fact, capital flow by source of lending? Because some lending, one person asked, is it in fact extractive rather than supportive? So let me just briefly say that the methodologies of tracking funding and flows and gaps could allow one to understand the source of the capital potentially. But we probably only have time for this question, but I wonder if Melanie, Robin, or Tawana want to jump in just very briefly with your sense of how you've either seen or understood whether capital is always good, or how an exercise like this might be used to explore what is indeed good or not good in terms of capital deployment.
But one of the things we've seen in our work is that a lot of communities, especially around transit or in other places where amenities are being developed, really need to think about enabling environment strategies at the same time that they're seeing investment come in. And so if, for example, you know that a community is at risk and you start by making sure that you're changing policies around evictions, around tenant rights, around creating permanent affordability through land trusts and other mechanisms, and you do that at the same time as the investment is happening, or preferably before, then you at least can mitigate some of the negative effects of investment on a community. That's why we say that the pipeline and the enabling environment work needs to happen together.
That's terrific. I have so many other good questions here, and I regret that we don't have enough time to dig into them. I'm sorry for that. But we will include contact information in the send, and so feel free to reach out if you'd like to discuss any of these questions, and I'd be happy as well to connect you with Tawana and Melanie and Robin to hear about the work that they're doing around the country and also in Minneapolis and St. Paul. And then also feel free to reach out if you've got questions about how to operationalize gaps and flow measures and also community needs assessment. So want to end there, so we're promptly on time. Thank you all so much for joining. This was a really neat session for me to participate in. I hope you thought the same. And we will follow up with other resources, and feel free to be in touch. Thanks.
Thank you, Brett.